So let's dive into one of the biggest puzzles in finance right now. The stock market is absolutely soaring, but at the same time, all the economic headlines look, well, pretty grim. Is this just 2008 all over again, or are we looking at something totally different? Let's get into it.
Okay, so on one hand, you have the bulls. And man, are they confident. In 2025 alone, a staggering $125 billion has poured into the S&P 500. Investors are just shoveling money into the market at a record pace.
But then, you flip the coin, and this is where it gets really weird. In that exact same time frame, companies have announced 1.2 million job cuts. That's the biggest wave of layoffs we've seen since the pandemic. So what in the world is going on?
And that is the great contradiction. We've got this massive flood of money rushing into stocks, right? As the economy looks like it's teetering on the edge. So why are investors so optimistic when the job market looks so pessimistic? It just doesn't seem to add up.
And to add a little more fuel to the fire, the unemployment rate just ticked up to 4.6%. Now that jump just triggered something called the SOM rule. And you really need to know, this indicator is an incredibly reliable signal that a recession is getting started. When this light flashes, it's almost always right.
So when you put all of these signals together, the layoffs, rising unemployment, a recession indicator going off, it naturally leads to one big scary question, right? Are we just watching a rerun of the lead-up to the 2008 financial crisis? Is this the biggest trap in financial history?
Well, the source material we're looking at today points to a pretty chilling parallel. Let's rewind to 2007. The economy starts to show cracks, so what does the Fed do? It starts cutting interest rates. That pushed investors out of cash and into stocks, which sent the S&P 500 to a brand new all-time high right as unemployment was starting to climb. They were lured in at the absolute worst possible moment.
And this is where it gets kind of spooky. Just look at the checklist. 2007, Fed's cutting rates, markets at a peak, margin debt is exploding, and unemployment is on the rise. Now look at today, 2025. Every single one of those boxes is checked again. The playbook looks identical.
But according to the source, there's another dangerous ingredient in today's cocktail. It's not just that investors are buying at the top. It's that they're buying into a market with a price-to-earnings ratio of 22.5. To put it simply, that means stocks are at one of their most expensive points in all of history. So, the case for a 2008-style crash seems pretty open and shut, right? But here's the twist. The analysis we're exploring today argues this whole thing is a classic head fake, that the real historical parallel, it isn't 2008 at all, it's 1999.
And this brings up a really crucial point. While unemployment and what the Fed is doing are important, what if they aren't the main drivers of this specific market? What if everyone is totally focused on the wrong indicator? And here is where the argument completely flips on its head. The source argues that the one metric that truly matters right now is corporate earnings. And unlike 2008, when earnings were totally collapsing, today S&P 500 earnings aren't just holding steady, they are actually accelerating higher, even with rising unemployment. So where is all this growth coming from? Well, you can see it right here. The engine of this whole thing is the information and technology sector. It is the clear outlier with a massive 21% growth in earnings this year. And this is being driven by historic investment in AI, which is tracking almost perfectly with the internet boom of the late 1990s.
Okay, so if a weak economy isn't what's going to end this bull run, then what is? The source suggests that to figure that out, we need to look at what actually killed the dot-com bubble.
This sequence is absolutely crucial. Back in the late 90s, you had a tech boom fueling the market. The Fed at first cut rates, which just added more fuel to the fire. The bull market only died when the Fed slammed on the brakes and started to aggressively hike interest rates to cool things down. You see, it wasn't the economy that popped the bubble, it was the Fed taking away the punch.
And that brings us right back to today. Right now, the Federal Reserve is still lowering interest rates. So, according to this model, we're still in phase 2 of that bubble sequence, not the final phase. As crazy as it might sound, this suggests the final dizzying peak might not be here just yet.
So, what does all of this actually mean if you're trying to make sense of this market? Let's put the core conclusion of this entire analysis right on the table. And here it is, direct from the source, Bravo's research. The end of this bull market will look a lot more like 1999 than 2008. What that implies is that the final phase could still be driven by tech euphoria, and that the end might not come with a recessionary whimper, but with a bang caused by the Fed.
All right, let's just recap the key takeaways here. First, and this is a big one, Just because things look like 2008 on the surface doesn't mean they are. Second, the real health of corporate earnings, especially in tech, might be a much more important signal to watch. And finally, the trigger for the end of this party might not be a recession, but actually the Fed's decision to start raising rates again.
And that leaves us with one final, massive question to chew on. This entire analysis puts corporate earnings at the very center of the story. So the crucial question for anyone watching this market is this: if earnings are the key, what story are they telling us right now, and what will they tell us tomorrow?